The time value of money, TVM, is a fundamental financial concept that asserts money available today is worth more than the same amount in the future due to its earning potential over time. This concept is anchored around the idea that money can earn interest, meaning that any amount of money is worth more the sooner it is received. Imagine you have an option between receiving $100 today or 1 year from now. If you take the $100 now, you can invest it and earn interest, ultimately having more than $100 in a year. This underlying principle is why TVM is crucial for both personal finance and business investment decisions. In calculating TVM, several key components come into play: present value, PV, future value, FV, interest rate, R, the number of periods, and sometimes payment, PMT, when dealing with annuities. The period can refer to anything from years to months, depending on the context. The formulas central to TVM calculations are FV equals PV asterisk open parenthesis 1 plus or close parenthesis to the power of N, which calculates what an investment made today will be worth in the future, and PV equals FV slash open parenthesis 1 plus or close parenthesis to the power of N, which calculates what a future amount of money is worth today. Another essential consideration is the interest rate, which can be simple or compound. Simple interest is calculated only on the principal amount, while compound interest is calculated on the principal amount and also on any accumulated interest. Compounding can occur annually, semi-annually, quarterly, monthly, or even daily, significantly affecting the total amount of interest earned over time. For instance, consider an investment of $1,000 with an annual interest rate of 5%. If this interest is compounded annually, after 1 year, the investment will be worth $1,050. However, if compounded monthly, the investment will grow slightly faster, illustrating the power of compounding. Understanding TVM is essential for making informed financial decisions, whether one is planning for retirement, considering a mortgage, evaluating investment opportunities, or managing personal savings. It helps in comparing investment options, assessing the value of future cash flows, and ultimately ensuring that one's financial resources are allocated in a way that maximizes wealth. By appreciating the time value of money, one can better navigate financial planning and investment strategies to achieve long-term financial goals. Time value of money, TVM, is a financial principle that states the value of money changes over time due to its potential to earn returns or appreciate. TVM usage can be seen in several financial aspects. Investment analysis. TVM helps in comparing the value of money today with its value in the future due to potential returns. For example, it aids in determining whether to invest in a project by comparing the present value of expected returns to the initial investment. Loans and mortgages. TVM is used to calculate the present and future value of payments for loans and mortgages. It helps in determining how much will be paid in interest and the overall cost of borrowing over time. Retirement planning. TVM is utilized to estimate how much money needs to be saved and invested now to achieve a desired amount in the future for retirement. This includes factoring in interest rates, inflation, and other variables. Bonds and securities pricing. TVM is crucial in determining the price of bonds and other fixed income securities by calculating the present value of future interest payments and the principal repayment. Savings and investment planning. TVM helps individuals in deciding how much to save and where to invest by comparing different saving and investment options and their future values. Capital budgeting. Companies use TVM in capital budgeting to evaluate the profitability of projects by comparing the present value of cash flows generated by the project to the cost of the investment. Understanding TVM allows individuals and businesses to make better financial decisions by taking into account the impact of time on money, ensuring that investments, savings, and expenditures are optimized for maximum return and minimum cost.